the insurance companies.
Yeah.
Kind of divide folks into two major parts: insurance companies and providers. So no particular order. Start off with others. Paul Maslach is the director of the overall group of insurance companies in the state. Make some comments. Take about 2-3 minutes. Keep an eye on it, but then we'll go to some others. And then the idea is that we can go through both segments quickly. We can come back and have some exchange of views.
Thank you, Senator.
We're joined by Marty Golden, the late Marty Golden.
Thank you, Mr. Chairman.
Thank you, Senator. I'll try and be brief. I know there's some other plan representatives, so they will fill in some blanks I might leave. I want to focus on the DFS role in setting appropriate and adequate rates as it applies not only to Health Republic, but the overall industry. And it's really that broader issue, I think, that Senator Seward alluded to in terms of, the role of prior approval in terms of Health Republic and solvency and stability in the healthcare market and the need for an examination of it. It's HPA's position that prior approval is a failed state policy, that as it currently exists, it provides the superintendent with unfettered discretion to set rates. He can raise rates, he can lower rates, and he's supposed to do it according to actuarial methodologies and assumptions. But I would dare say that neither you nor I would ever know what those actuarial methodologies and assumptions are because they are opaque in terms of the disclosure of them. The subjective nature of that discretion is something that definitely needs to be examined. It leads to a political suppression of the rates. And it's something that we raised when the prior approval law was under consideration 2009, 2010, that the prior utilization of prior approval led to suppression of rates, and we had that experience, and we said it would happen again. And if we look at the current track record of rate setting by DFS, it has occurred once again. So we sit here today, DFS really had to balance two goals. They had a balance looking for the lowest premium that could be provided while maintaining the solvency and stability of the marketplace. So how did that play out for Health Republic? Mr. Ochsner alluded to the fact that they did approve Health Republic's actuarially certified rates when they came in as submitted, and for the 2014 rates that did occur. However, I would point out that the rate was substantially lower than anybody else in the marketplace. It was 29% lower, cheaper than the average of other plans in the state. $142 a month cheaper. This from a new plan with no experience, no track record, no knowledge of the marketplace, which other people were likewise struggling with a broad network that was paying a premium level of reimbursement. That should have been a red flag. That's all the time I have?
Yeah.
All right.
Now we go to William Golden.
Well, I'll echo Paul's comments, and as a frustration to us, when we sat and looked at who we compete with in the marketplace, the Blue Cross plans, the larger for-profit and not-profit plans, relatively predictable. It's an efficient marketplace we have in New York. So it is, it's a marketplace that if you price your products too high in larger group, you lose membership. That's just fact. And in the community rated market, we really rely on the marketplace to be efficient by decisions by regulators. And our concern is, if we went backwards, when we looked at the rates that were being filed for Health Republic, regardless if they were actuarial approved, I don't think you need to be an actuary, you don't need to be an underwriter, and you don't need to be an Ivy League MBA to suggest that someone could come in, create an insurance organization overnight, and be 30% cheaper than the largest payer in the marketplace. It's just not possible. So we spent a decent amount of time talking to people around this table, brokers, other insurance organizations, legislators, and regulators, that this is not sustainable in any business environment. You can't take it what the experience of a Blue Cross or a United over the last 10, 15 years in a relatively predictable marketplace and have rates that are so far below that I think, as we talk about, we know that everybody knew that this was going to happen. Well, it just happened a little quicker, I think, than we all thought. So, you know, there has to be some balance between what we file, communication that goes back and forth between what is actuarially sound and then just what's appropriate in the marketplace. And I'll go back to what I said in the beginning. We have a very aggressive minimum loss ratio in this state. Federal government says it's 80. We've decided in this state it's going to be 82. Prior approval is duplicative in that scenario, right? We don't want to raise rates in an efficient marketplace to lose membership. Our rates are there to make sure that we're solvent and that we have the ability to meet our requirements going forward to our consumers and to our providers.
Okay. Bill, thank you. We're going to go off Dave Anderson, Health Now.
Okay. Just a couple of fact points to echo some of the comments. In the Silver Plan of Benefits, which is the most commonly compared plan of benefits, in my two major operating regions, Health Republic in the Western New York was 41% below my premium rates. And in Eastern New York, they were, on that plan of benefits, they were about 33% below. So I'm not sure what the department actuaries were, you know, what their review was and what they're looking at, but our actuaries would suggest that that's nowhere close to reality. And those rates were in the market for more than just 2014. So it was predictable. I think, as Bill said, I don't think you need to be a Harvard MBA to see that that situation is not sustainable. And we have substantiated the fact that our cost structure and what we have in our network was lower cost than what Health Republic had in their network. So to have rates lower and costs that were higher is not sustainable, and I think was very predictable. I'd also like to add the comment on the department's comment about that these members were successfully transitioned. On December 1st, our plan received about 4,000 Health Republic members. I'm very proud of our health plan community and how they stepped up to the plate, and we took all comers at that point on December 1st. We received about 4,000 of those. Only about 60% of those, however, have paid their premium. So I would challenge the idea that this transition has really been successful. They've enrolled, and they are members in the plan, but many of them have not paid their premium as of yet, and I don't think there's any chance that they're going to. So the problem is ongoing. This wasn't something that erupted and we all reacted to and resolved in 2015. This is an issue that's going to carry on and will add cost to the plans and cost to our communities and to our members for some time to come.
Thank you. Mr. Doolin? Doolin, yeah. On behalf of Blues and a few others?
Sure. You know, I frankly don't blame the department for the position that they're in on prior approval. Any rate increase is politically undesirable. It becomes more difficult when a company whose rates are woefully inadequate, as mentioned earlier, that comes in for a continued inadequate rate to increase that rate by more than what was requested. And that's the fatal flaw in the process. Whether it's Health Republic today, or for that matter, Empire Blue Cross in the early 90s, which preceded the repeal of prior approval. Once the department approves the rate and has the power to approve the rate, they own the rate. And they are under the scrutiny of the public, because consumers don't like rate increases, the plans, quite frankly, don't like rate increases, and government doesn't like rate increases. And that's why, frankly, whether it was 1995 or when we had discussions in 2010, I call the Premium Integrity Act, where we actually envisioned this exact scenario where if a plan was losing money, had a high MLR, medical loss ratio, meaning the amount that they were taking in premiums was exceeding what they were paying in claims, that the department's unlimited discretion was curtailed, and they were forced under statute to provide the adequate rate. And frankly, that was not only in the best interest of the plans, but it would be in the best interest of the department as well, because they would not be subject to that political pressure of having to approve a high rate increase.
Thank you.
Thank you.
Craig, why don't we go brokers?
Thanks. It's unfortunate that that this situation really is brought to light to many of you who were not previously aware the value of agents and brokers. I think in the context of understanding and fixing this in the future, I think understanding communications and educating the public is of paramount importance. I will say that for many of the purchases of Health Republic, it was a price decision. They looked at the price of the health insurance coverage and they bought it. A lot of agents and brokers advised our clients of the risk. We knew the risk too. We understood that the situation was dire and that the rates were unsustainable. I will have to say as a side note that my firm only had 8 Health Republic members, 8 people insured by Health Republic, because we took an active position with our customers that the rates were unsustainable and it would be an issue. So I'd like to emphasize that whatever decision is reached, communication and understanding by the public has not been solved. Even today, even customers who had Health Republic don't even understand what went on. The second issue that I think we want to raise is just promoting stable, vibrant coverage. I don't think it's enough to have a greater number of insurance companies in the marketplace. I think we need to re-attract the right players into the marketplace, the vibrant, solvent, competitive players. When you look at Aetna, Cigna, United, Blue Cross, you look at the way they've curtailed their involvement in small group and in individual marketplace. I think that's an indictment to the way we run healthcare in New York State as compared with the rest of the country. There are markets where there are vibrant, viable, competitive carriers that are not being forced out of the marketplace, and I think in our marketplace we're seeing those the curtailment of participation by those players, and I think that's a problem. Thank you.
Kind of a transition from insurance to provider and all of that, Harold Island.
Right.
Who you might have heard a slight allusion to what Harold's been doing on behalf of the, I guess it's the Medicaid redesign team and handling or co-chairing a value-based payment system study, which has involved a cross-section of healthcare in this state and is about to start some real basic core changes. CMS has done it, the state is now announcing it's doing it to the waiver. And I just think that as we're contemplating where we are now, Harold, if you could also touch upon where we're going. It's a whole different forum, but it's a very important forum that touches everything else we're doing.
Well, thank you. And I did actually want to focus my few minutes on looking ahead. Wasn't sure I was going to talk about value-based payments, but we do, as maybe going last for the insurance side of the house, I do want to think about what happens now. And we're at the start of a new year. It's a good time for straight talk and not euphemisms. So let's start with the fact that a guarantee fund, which you've heard about, and I expect you'll hear a little more, is nothing but a tax on health insurance consumers. And I would just ask the question, what possible public policy is there that would justify taxing consumers for this mess of Health Republic? None. That doesn't mean that the injured parties shouldn't, to some degree, be made whole. And who are the injured parties? Yes, the providers, yes, the brokers, and yes, the health plans too. health plans are sustaining losses as a result of Health Republic, just like the other sectors are. So there is a discussion that needs to be had about how do we address the injuries that have been sustained. And you've alluded, we have to collect the assets, figure out what the creditors are owed, and have an orderly process and see if we can identify some funding. But taxing consumers for this is insane. Right now, our insurance is already too expensive in New York, notwithstanding the efforts of the marketplace to introduce competition and have market efficiencies, forget the underpricing. But the solution cannot be, I'll just wait for a minute. But we can't solve this on the backs of the consumers. That's the wrong thing to do. I mean, we could have a discussion about value-based payments. I'm involved. Many people around this table are involved. I mean, that is a long-term question about how do we rethink how health plans reimburse providers. And there is some thought to be given to that, given what we know happened in Health Republic. Their unit costs were too high, and you've heard that. I think that's sort of largely a different discussion to have. So I'll finish up here, but surprisingly, and we can go on and come back and have the discussion.
We do have time, and everybody has been remarkably succinct. It is welcome when we deal with policy. Kind of transitioning over to provider, Dr. Hayworth, you run a group of physicians who are in a practice. You have about 400 physicians?
425 plus. Yeah, and I run a Harvard MBA. I am a physician. And one thing you should realize is that in November, we received a lot more Health Republic patients as people rushed in, enrolled, and never sought care, and rushed in November to seek care because they were all worried that in December their care would go away, their insurance would go away. So our receivable, which is in the millions, got much larger in November as people sought care that we weren't being reimbursed for. Our physicians are concerned that other state-developed insurance programs might also fail and will be in this position again. Failure to reimburse for good faith services inhibits our ability to reassure.
Doctor, I think we're going to speak directly into the mic, and I'm as guilty of this as anybody, but you almost literally have to be up close because I've gotten feedback from the audiences beyond this room. We're being webcast, and the webcast people can't hear us well.
I'm sorry, sir. Failure to reimburse for good faith services inhibits our ability to reassure existing and new physicians about the stability of our market. Very large medical group is expensive, and we depend on this revenue to pay for our employees and all our other expenses. Go back. Okay. I'm glad Harold on my side. Harold's very used to this. As I said, I'm a physician. Unfortunately, mass payments won't be enough. The state must assure physicians that they will be paid for all care provided to thousands of patients covered by the insolvency of Health Republic. The state must immediately address Health Republic's demise and protect patients and physicians in the event of future sudden health insurance and market failures. There's nothing more important to us than the mission to serve our patients. Despite the upset of hundreds of our individual physicians, MKMG remains committed to provide care to state exchange patients. However, the future may be uncertain if we don't receive payment for the services provided. Lack of stability in the marketplace and the rate-setting process presents a challenge to physicians and providers. My physicians want to participate and create access for patients, but they want to participate knowing that they will be compensated fairly for providing services. This is their livelihood. Thank you, Senator.
Thank you very much. Moving over to the hospital segment, Kathy Shore for Greater New York Hospital Association.
Thank you, Senator. First, I do want to compliment the two departments on the job they did in transitioning patients throughout this whole process. It was a very difficult job. It had to be accomplished in a very short time frame. And I think part of the reason for the short time frame was what Troy had alluded to. Initially, the plan was to try and phase Health Republic out over a number of months, individuals to the end of the year, small groups potentially as they renewed, if that was possible. But when they went in and found a worse financial situation than they thought, they accelerated that process. And that was the right thing to do at the time. But the main reason that they did that is that they were concerned that the provider networks would fall apart, because once people were not getting paid, providers would begin terminating their contracts under the rights they had under those contracts. And once that happened, people would not have access to care, and that was their main concern. But I think a lot of that could have been avoided if, in fact, we did have a guarantee fund in place. Because if we had a guarantee fund in place, then providers would know that although it may take a long time, eventually they would have been paid. And that would have allowed more time for patients to be educated about their choices, what they had to do to re-enroll. We could have avoided all of those December issues that arose for the plans and providers alike. So I think having a guarantee fund, and the reason 49 other states have guarantee funds, is to allow for a smooth transition in just this type of situation. So the other thing I'd like to comment on is something that Harold raised, and Troy also, about the uniqueness of the Health Republic situation. And Health Republic, as an insurer, was unique. They were a co-op, not many of them across the country, and that was a new kind of organization. But the failure, the insolvency of a health plan is not unique. It's happened several other times in the last 15, 20 years, and it will likely happen again. And so we need to have something in place that addresses the situation when a health plan does fail. Now, a guarantee fund such as we're proposing is not an ongoing tax on consumers or on insurers. It only is imposed when an insurer fails. So if there's no insurer that fails in the next 20 years, it will never be imposed. But if we do have another failure, and I bet we will, hopefully not for a long time, but if we do have another failure, we need to have mechanisms in place to make sure the process can be accomplished smoothly. And lastly, I do want to mention that everybody during this process, I think, came to the table and tried to make sure that the impact on patients was minimal. Hospitals did that. They did the right thing. They could have begun terminating their contracts back in September when this all started unraveling, but they didn't. They stayed contracted. They provided emergent care. They provided urgent care and non-urgent care over the last few months. And as a result of that, they're left with, based on the survey that we and Haney's did, ending in October, $165 million in outstanding liabilities at that point. And once we add the November claims in, we are expecting that it will approach $200 million. So we believe that it is not fair that the hospitals and physicians across the state be left with those kinds of liabilities, and that we need to take action so that in the future, if this happens again, we're not sitting here a month later trying to figure out what we could have done better to make the process run smoother.
Thank you. Appreciate it. The head of the Medical Society has weathered the traffic, Joseph Maldonado, and make comment right into the mic.
Thank you. It's a pleasure to be here. I am a physician, and I do have an MBA, and I think that having some business knowledge is also important to the profession, particularly in these days where the practice of medicine has become a more difficult task for physicians. We'd like to also congratulate the BFS and the Department of Health for the work that they have done in this transition. It has been bumpy. There are no assurances that we have been made as providers that we will be made whole, but we're awaiting a response by the governor's office and by the Senate and Assembly to be able to address that issue. The issue of making physicians whole is extremely important because many of the practices that have been harmed are in fledgling situations. Physicians, small practices, large practices, are really stretched at this point in terms of their abilities to weather the financial hit that has been wrought upon them with the Health Republic. The Medical Society, the physicians of the state of New York have worked with the Department of Health to advance some of the health initiatives, for example, the SHIP and the DSRIP. If we're to move the residents of the state of New York to a new model of how we deliver health care, it is crucial that providers have a sense of security, of knowing that they're going to be able to get through that storm if there's another storm. What you have before you is a financial disaster to thousands of practices in the state of New York that now make providers sit back and say, do I really want to participate in the next iteration that's coming down the turnpike in terms of the SHIP, in terms of the DSRIP? I have an option to walk away from that and say I'm not going to participate. If you don't provide a guarantee, if you don't provide a special fund, then what you're doing is you're leaving the providers in a situation of saying, I have to fend for myself and I can't afford to take another risk, another chance with the next iteration that's being brought down our pike. I think that with regard to the rates, this is the 12th company in the country that has gone bankrupt. I'm not sure that it's because of the rates, but I certainly think that there are a lot of factors that are involved in that. The crucial thing is to be able, going forward, to assure providers that when they participate in the next iteration of healthcare reforms in the state of New York, that the state of New York is going to stand behind them because they have made good on their word by providing and making them whole with regard to the Health Republic situation. Thank you.
Thank you. And Jeff Gold, representing Haney's Hospital Association of the State of New York.
Thank you, Senator. I'll be very brief. We share Kathy and Dr. Maldonado's view of the need for guarantee fund. I also share Harold's view that straight talk is necessary and the need to stop dancing around some of the things that, again, go back to being predictable, needs to happen now. Due respect to the department, this idea of modest payments, let's be real. If the answer is there's not really going to be any, let's just say it. Let's just say it and recognize that they're going to be a pittance and that we need to either look to some state remedy or there's not going to be anything coming from the feds, there's not going to be anything coming realistically from the marshaled assets that's meaningful, and the loss is going to be enormous. Let's just say it if that's what it really is. Let's just say it if this company's not really functioning in the months of November, and we're asking providers to live with bounced checks and medical record requests, phones that are not being answered. Let's not make believe this company's functioning. And I think dancing around reality has been part of how we got here, and I don't want to keep doing it. So we support Guarantee Fund. We think these guys were out of business fairly early on, and if there were a Guarantee Fund, to Kathy's point, then all of the transitional angst could have been minimized because it wouldn't have mattered so much. But without a Guarantee Fund, all of the transitional angst made it that much worse, and holding out hope for modest payments that they're not really for real is not going to help the debate. We need to figure out whether we're going to make providers whole through some state bailout, allocation, guarantee fund, or other mechanism or not. Thank you.
Has there been and shared with any of the providers, has there been any evidence that services are not being rendered?
As far as I know, everybody, all hospitals are doing everything, covering everybody, providing all services. But they're doing that, I mean, even in November when we knew there were no more payments coming, the idea that we were still pumping services into the abyss with no hope of payment just seemed absurd. In Colorado, I think on December 22nd, they announced that plan was going to close, and there was going to be an order of liquidation January 4. It was just days. It was like, enough already. They're closed. And so, this making believe this thing is still functioning only makes it worse with no guarantee fund.
From the provider's side, was there any type of warning? Was there any canary in the coal mine that would have given you an evidence that something was about to happen?
I think we were starting to hear about late payments. We were starting to hear about concern. Dr. Hayworth's point that people were running for coverage in November, those things were alarming.
Dr. Montano.
We actually did approach the Department of Health and the Department of Financial Services, I think a year before that, to make them aware that there were providers who were coming to us to inform us that they would not be staying on with Health Republic because they were having problems with payments and they were having problems with denials on those payments. And we started working with them to see if that process could be remedied, but there were warnings at least a year ahead.
Dr. Hayworth?
But Health Republic, the bills were getting paid until really the end of September, early October. We started to see a slowdown in payments. And then obviously when Mr. Oxner did shut the plan down, and then we were receiving almost no payments at all. So for about 6-7 week period, we were really almost no payments.
We've gone around, everybody's commented. Certainly, you've gotten a lot of involvement in policy. Do you want to make any kind of comment before we go into interaction here?
Sure. I mean, I think we recognize that...
Closer, Troy.
We definitely recognize that providers, health plans, and brokers have all been impacted by this. With regard to prior approval, as I mentioned, the department does make our decisions based on the rate submission process. There's a legal process for us reviewing the rates. In this instance, Millman, which is a nationally recognized actuarial firm, one of the leading firms in the country. A lot of other companies use their actuarial tables to make their rates. Millman had certified their rates, and our actuaries looked at them and by and large agreed with those rates. And I think a lot of the pieces that we're talking about, the funding cuts to the for the loans to Health Republic, like other co-ops, as well as the risk corridor cuts, really had a major impact, and were not foreseeable in 2014 when those rates were initially set. In terms of just prior approval we do, all of our rates, as I said, are reviewed by our actuaries, are certified, and we view it as a really crucial and important consumer protection in making sure that the rates are sound and are reasonable and not excessive or inadequate. So, I guess I'd say that about the prior approval process, that they were actuarially supported, and we feel strongly that we did the right thing at the time, given the uncertainty of the market. And you look back at it, everybody was uncertain about what was going to happen in 2014, particularly in states like New York with broken individual markets. And that was part of the idea of the Risk Corridor Program. The Risk Corridor Program was to help with that uncertainty, and that was cut as well. And again, we didn't even know about the effects of that until October. We took very decisive action to shut them down because we didn't want to risk putting consumers and providers at further risk.
Do you have any comment?
Not this time.
Let's throw it open. I figured we should have some comment here, but I figure this is pretty murky in regard to trying to resolve policy. But one of the things that it struck me that I've heard was that the prior approval process is a bit opaque, and that sometimes when rates are given back to plans that have been submitted by actuaries that are certified under penalty of law, that they're given back to plans with changes that are not certified, that the plans don't know what's taking place. Is that correct? So that it seems to me that part of this murky process is trying to make it more transparent, try to make it clearer, try to make it, and I don't know if that would result in court suits or just make it clear to everybody what's actually happening. And of course, plans are very competitive, so they're going to be looking over everybody's shoulder to figure out what's going on. But that wouldn't be a bad thing, because it would tend to drive rates down if people get to be competitive. They're certainly not going to be benefited. Mr. Golden said if they raise rates, they'll lose customers. So I'm just wondering what type of whether that's a direction to go in or not. And I just throw this out. Knowing that no one has an opinion here. How about some comments, and let me be moderator instead of...
Well, can I jump in? Because
yes,
I want to respond to your comment that it's murky and something Troy just said. because I think it sort of highlights the fundamental problem with prior approval. And look, we all understand, you know, things are moving, it's easy to look back and say, oh, that was wrong. But there is a fundamental issue in the prior approval process, and you heard it earlier. And I don't want to move away from it just yet, because you heard Bill and Dave say the rates were 25, 30, 40% below other companies in the market. And then you just heard Troy say the department looked at the rates and largely agreed with what the company submitted and thought they were right. Now, both things can't be true with hindsight. Either the rates were wrong and the department, you know, may be acting in good faith, but nonetheless, you know, looked at it and got it wrong, or the rates were right and everybody else in the market was wrong. But it can't be both. And I'm not faulting the department's actuaries. I mean, again, it's easy to look back. What I'm faulting is the process that was used and that is still used in prior approval. And that's, I think, an important point that we shouldn't run away from just yet. And I don't know, Bill or Dave, if you want to weigh in on that?
Well,